Tim, it's great to speak with you because not only are you the vice chair of the investment firm, but you also run all things real estate. So I want to start there with you because sure. Fortress, $50 billion AUM and $18 billion specifically in real estate. Mm-hmm. Walk me through the real estate portfolio and what's compelling, what's attractive right now.
Yeah, so one of the real strengths of Fortress is even within that $50 billion, we're a very diversified asset manager, and real estate's a big part of what we do. We have funds in Japan that invest in real estate equity. We've got a non-performing loan fund in Europe. And then in the U.S., we focus on both debt and equity. And then we also have some REITs, and we also have some sale-leaseback, net lease vehicles. So we've got a really, really broad portfolio and see kind of across the landscape, which makes it really interesting.
Yeah. Multifamily and housing, other areas of commercial real estate. What's exciting right now and why?
Everything's exciting. Right? I've been around real estate for most of my career. I've been through 4 real estate cycles. Every time I go through a cycle, I say, oh my gosh, this is the greatest opportunity that I've ever seen, and that's what we're going through right now. The cycles are caused by different factors. This one was primarily caused by the fact that rates were next to zero for a number of years, and that meant that any property that was purchased during that period or a loan that was made is probably in a bit of trouble. Right? Now, the backdrop for that is that from an investing side today or a lending side today, the values are down to more reasonable levels. They're down 10 to 30% for well-performing properties. Again, just because of rates. Office is absolutely different. We can talk about that. That's a lot of carnage going on there. But what's also really interesting is that because this cycle was not caused by an economic downturn or massive overbuilding, the underlying property performance is actually pretty good, right? So you've got lower values, better operating performance. And then I think the other factor that we talked about a little bit earlier was that there is a $4 trillion maturity wall that's occurring over the next few years, and that creates opportunity from a lending standpoint. So we are very focused across the real estate landscape. We like debt and we like equity.
It's interesting to hear you say that because so many of the conversations we have is that, we're in a high, or we'll say elevated versus recent years, rate environment, and that puts pressure on real estate. But for a firm such as Fortress, that means an opportunity specifically on the distressed side.
That's right. Well, and sometimes not even distress. I mean, most of the banks in this country have said loud and clear, we want to reduce our real estate exposure. So that creates an opportunity for us to make very high quality, first mortgage, senior loans to properties that are performing well by asking our customer, the borrower, to bring in a little bit of equity. And we've got a very well-performing loan, and that's an exciting part of our business.
So you said carnage in office. Where's the carnage? Where are you seeing it?
Well, clearly there's been a lot of cross currents that have created the carnage in office. I think what you're seeing is somewhat similar to what we went through with large malls when the impact of online buying occurred, where B and C quality malls were just worth a lot less. Sometimes they were actually worthless, and they were really only worth the land that was under them. What we're seeing right now in office is a bifurcation based upon submarkets. So, for example, in New York, the office markets in and around the transportation hubs of Penn Station or Grand Central Station are actually performing well. Now, values are down, but leases are being made. Properties are being sold at relatively reasonable prices. Another great example is in Los Angeles, where downtown Los Angeles, the traditional downtown, is under a lot of stress. If you go 10 miles to the west in Century City or Culver City, the market's fine. In fact, they're building a new office building. So it's become much, much more localized.
Because we are sitting an hour outside of L.A., I know the Pacific Coast Highway has been opened back up, but you're still seeing all of the cleanup, all of the rebuilding. I do want to get your thoughts on how you assess risk when it comes to natural disasters, when it comes to fires, and being based in L.A., what that rebuilding effort actually looks like.
Well, I think it's slow, right? And it's slow because it's complicated. You know, there are a lot of folks involved. There are state laws, there are local laws. They've got to deal with what are you going to do with this contaminated soil. And then homeowners have to decide whether or not they want to rebuild based upon, you know, where they are in their lives or whether they have insurance. And so it's going to take a number of years to really rebuild. But your point about taking into consideration the risk of fires or hurricanes if you're in Florida or floods if you're in other parts of the country is a really, really important part of our underlying credit analysis. And we absolutely take that into consideration. And in some cases, there are areas where we're just not as active because we're concerned about the underlying risk of weather.